Is there anybody familiar with, I did ask a question earlier, there was only the one person. Was it Simon this morning that was familiar with the Hurst component? Hurst component, Hurst exponent, God's sake. So, price. Okay, so this is the basic idea here. It is, as I said, used in some models of option pricing, not all models. It's not the most common method, of course, of calculating, but the basic idea is this. Okay, we'll call this the trend line. We'll call this the real line, the mean reversion line. So one of the things we start recognizing is the key to understanding and using this is to recognize this phase here. Okay? Is this bullish or bearish? Simon, you know about it. Klaus, you know about it. Is this bullish or bearish? A lot of people get tripped up with this one. A lot of people get tripped up with this kind of idea here. Is that bullish or bearish? Well, the answer is we don't know. We don't know if that's bullish or bearish because all we know is it's a volatility expansion, okay? So if we look at this, all this means is it's a volatility expansion trade, okay? So this is a trending trade. So obviously if this is a volatility expansion, if the price starts here, it's going to be linked to either a bull or a bear trade. So it could be this trade here, or it could be this trade here. It doesn't tell us which one it is. Okay? So if I dismiss this for a second, and we just leave that one on the charts, then of course this means that the market is volatile, bearish. In other words, it's almost like an ease of movement, if you like. It's almost like the slippiness is to the bear side. Does that make sense in terms of volatility pricing? So it points to the direction of the slippiness. So if it points to the direction of the slippiness, this tells us that this is bearish. So we should be selling pullbacks. And what should happen, of course, during a pullback is what? Well, during a pullback now, what should happen is, of course, this should now drop down to the mean reversion narrative. Because it's mean reverting. It's reverting back into mid-pricing. So when it starts getting too far into this, what we're going to be starting to look for is we're starting to now recognize a timing point. We're starting to recognize a timing point in Hurst just in here. And what we can start seeing is we can start recognizing an opportunity to maybe sell back in line with the trend in here. You understand? And what happens, obviously, if the price then doesn't do very much, is that it'll start going into this phase here. And what will happen? It'll start doing that as it trades down into the bottom edges. Do you see the opportunity now? If it starts doing that as it's coming into the bottom edges, the possibility is now that that's now going to be a bottom edge buy reversal. Why? Because if the mean reversion is now on the bear side, where's the trending trade? Where's the slippiness? Slippiness is on the buy side of the book, isn't it? So the slippiness is now on the buy side of the book. So if I can find a bit of business down here, I now know that there's probably going to be the slippy algorithms, because as I said, it is used in some market making algorithms for options. You get the idea that this should therefore be a relatively slippy ride north. Does that make sense? So these are things that we can start to spot. We can start to recognize these little areas. We can start to spot when the regression is in play, or when the reversion is in play rather, and we can start to spot when the trend starts to become slippy. It's about just keeping on track with which side is slippy and which side is not slippy. We sometimes can find that we get sticky on both sides. Sometimes we find that we can get slippy on both sides. But the point is, we can still recognize statistically which one is which. So we can start to recognize that little piece of the jigsaw puzzle. And obviously when we can tie it in, and we're not always able to tie it in, because sometimes you get just noise and it doesn't really give us any clear ideas about slippiness or anything else, then of course we start considering the possibility that there's nothing for us. Take a look at it just now as it's happening on the S&P. There's one trade on here that looks very obvious. This drive higher seems to come out of a period where there's no trend. So this drive higher obviously suggests that the trend is bullish, the slippiness is bullish, yes? We can see when it starts to get sticky, when that starts coming out at the top edge, and that would have given you a nice opportunity if you were long to close out your your long positions, okay? So you could have used that to close out your long positions just into that little phase there. But because the trend is slippy to the upside, what I'm looking for is I'm looking for a white line to appear and then diverge off the bottom edges. So we can see the white line absolutely clearly appears down here, and then the divergence comes in. Do you see where the buy trade is? You see the buy trade there? The lower it goes, the more chance we have of a trend taking place. So because we've got a trend buy and a sticky bear, then of course when we've got a sticky bear, flipping that book round at the sticky bear level, when the slippiness kicks back in again, some might say, but that slippiness is because the price has continued sell side. Oh, yes, it is actually true. You're right. It's because the price has continued sell side, but this is the divergence we're looking for. Because the last trend was bullish, we haven't taken out that bullish level. We are still in bullish structure. And therefore, in that line with that bullish structure, this is still, for me, a pullback trade. And therefore, I'm using the Hurst as a pullback indication here. And so long as when the price rallies, which in this case, it didn't at first. Do you see how when the price rallied here, we actually got a decline? And then it started to rally on the bull side. So that was good news, because that now gave you confidence that this is probably going to break north. When it starts to rally on the buy side, and then it breaks north, and then it does go into a very strong trend after that. You can see that this leg higher here goes a very strong trend again. Then, of course, we are now looking to buy into pullbacks. Unfortunately, you can see that the reversion kicks in there. And obviously, if you were still long at that stage, you would then be able to use that as your exit, just like we did the last time. Make sense? So these little things can find trades. They can find the reversal trades. They can find the buys at bottom edges. They can find sells at top edges. They can find pullbacks. It's an interesting little indicator. So when you see a value divergence on a trend, you can obviously start booking profits, or you could potentially flip. So that would have been a profit take to the right-hand side, or a sell. That wouldn't ever been anything really, because it never really did anything in there. We could obviously recognize that this could have been a profit take to the right-hand side. You could obviously start recognizing that declining is therefore going to then be a buy trade probably. But that would have been a case on this candle as well. So that's why I don't use it this way. That's why I don't use it this way. So when we start recognizing this, you can see that obviously this went far enough to say it was now in a sell trend. So if we are now looking at this S&P here and it's in a sell trend, what are we looking for? We're basically looking for a white line. And the white line should appear on an uptick. The white line should appear on an uptick, and if it doesn't appear on an uptick, then of course we haven't found any volatility narratives. So if the white line appears on an uptick, and it's obviously starting to decline again. I don't think we're going to get it, but it is what it is. We'll maybe see it in the future. Then, of course, that tells me that there's a possibility that there's now going to be, a compression of price. And that's what the white line tells us, a compression of price back in the direction of the trend. Because we've compressed the price down here, and then we're expecting to compress back up to the prior highs. That's what this tells me. And that's why it's sometimes used in some volatility models of option pricing. As I said, it's a little bit awkward. It's about basically the same as any volatility indicator, if you think about it, yes? It's basically just a volatility indicator. But it's obviously not based on the pricing of volatility. It's based on another developing storyline. It's based on different math behind it. So it's a volatility indicator. So when it's going up, it doesn't mean prices are going up. It means that volatility is expanding. So when it makes higher highs, you can obviously see that volatility is expanding in the direction of that trend. So obviously we can see that the most recent direction of trend is sell side. That's where volatility expanded. In other words, it's a way of being able to identify toxic behavior. So when we see that the toxic behavior is on the short sell, I now am looking for that compression of price, which should take us down into this white line area here. And then I could be looking to sell into that white line, which hasn't obviously happened. It is what it is. It's just another piece of possibly useful information. It doesn't have to be useful information. It's just one of those things, isn't it? It's just one of those things. Up to you if you use it, up to you if you like it, up to you if you look at it in the first place. I have no particular strong feelings about it one way or the other, but I thought it was worthwhile still mentioning it based on the fact that we've been talking about slippiness from yesterday's markets and the like. So it is something of importance to us.